Hey guys, thanks for joining us to learn more about the New Jersey grant for the $10,000 in down payment assistance. My name is Danny Valencia. I'm here with Michael Sema, President and CEO of Get a Rate Home Loans. We're going to go over some of the basics in regards to sellers' concessions, credit scores, and just getting pre-approved in general and how to start. So what would be step one?
Step one is really just the pre-approval process. Through the digital portal, you can take about 10 minutes and just complete basic information. Current address, first name, last name, social security, date of birth. You'll be able to see your outstanding liabilities, FICO scores, and
On a soft credit pull?
On a soft credit pull too, yeah. It doesn't affect your FICO scores. But once you complete the basic information, you'll be asked for a list of documents. In regards to this particular program through the state, you're going to have to upload 2 years of tax returns, W-2s or 1099s, most recent pay stubs. And if you wanted to also upload the cash reserves, just in case if you wanted to put a down payment, you can. But it's
just
pretty
to
simple.
show that you have some money saved,
Yeah.
even if it's not enough necessarily to purchase the home, but if you have something saved, it definitely helps
Definitely.
an underwriter
Right.
feel a little bit more comfortable.
Right, based on the risk
about
factor on the file.
Yeah.
Yeah, but you don't need it. Just like the previous video, we've helped first-time homebuyers purchase a home with less than $1,000 out of their pocket. And the first step again is just to verify the information, see exactly what your income is, what your credit is, and based on the underwriting guidelines for these FHA programs, it takes us a few minutes to take a look at it, and if it looks good, we can give you a pre-approval. That's step number one.
Yeah. And I think a lot of people think that they have to apply for this program separately. So the biggest thing here is we're just pre-approving you for an FHA loan, just like anyone else would be approved for an FHA loan, but then we're doing the work on our end, as Get a Rate is one of the handful of lenders that can even do the program in the state, to take it from there to get the actual grant. So you don't have to worry about applying for the grant. We just look over your documents and filling out the application just for a regular FHA program, and we take it from there.
Right.
In regards to the $1,000 that you can buy a home with, what are we talking about as far as what breaks down that $1,000?
So the out-of-pocket expenses during a purchase transaction before you buy the home are your appraisal fee and your inspection fee. What we've seen home buyers really do is work a seller's concession in the deal. A seller's concession is when you negotiate with the seller based on a specific purchase price, and based on what that agreed upon amount is, there's a specific credit that the seller is giving you for closing. So it's a seller's concession. They're going to be able to pay up to 6% of the purchase price. So in the state of New Jersey, if let's say for example, a purchase price is $280,000, and the minimum down payment for these FHA programs is 3.5%. Through the state grant, the 3.5% is going to be fully covered. All you have to do at that point is negotiate with the seller on the purchase price for the seller to pay for the closing costs. So the only two out-of-pocket expenses that a buyer needs to really incur, again, is the appraisal fee, which is about $575, and an inspection fee, which is a few $100s. So yeah, that's how you can really buy a house with less than $1,000 out of your pocket.
Yeah, and the inspection is something for you. You want to make sure that the property is in good condition. It's not necessarily a lender requirement, but it is an out-of-pocket expense. The appraisal is definitely something that we're going to look at, or the underwriter is going to look at, to see what the value of the house is and make sure that you're buying it for what it's worth, essentially, that you're not overpaying or underpaying for the property. So yeah, I think, the next step after getting into the process would be maybe talking about the credit and like how do you really know if you're eligible for this program.
Based on the credit for what now?
For the credit scores, so the minimums, maximums, what you need to qualify. So
the minimum FICO score for this program is a 620. So there's 3 credit bureaus that we take a look at. It's Experian, TransUnion, and Equifax. So when we pull the credit report, we're going to choose the middle FICO score out of all 3 of them. So as long as it's above a 620, you should be fine to qualify. The next step is the debt-to-income ratio, the amount of debt that you're going to have by owning a home compared to the income that you're currently showing on average for the past 2 years or year to date, just in case if you received an increase in pay. But once we figure out those ratios, we'll be able to know exactly what we could qualify you up to. But then the most important part is really what you want to qualify for. Just because you can qualify for a house up to $500,000 doesn't mean you should be looking at a house for $500,000. On our end, we put a really good a breakdown in front of you to let you know what future expenses to really prepare for by being a homeowner. And we have a calculator called the affordability calculator. We talk about lifestyle expenses. Do you have Netflix? How much do you spend in regards to groceries per week? And adding on those additional expenses, it's important to really know what you're going to have left over by purchasing a home. So yeah, that's
creating a budget so that, like you said, you may qualify for something that has a $3,000 a month mortgage payment, but you're only comfortable because you know your expenses with $2,000.
Right.
So we don't want to just push you all the way to the limit. We want to know what you're comfortable with and figure out the purchase price that'll get you where you need to be.
Right. And in regards to the grant, you wouldn't have to pay the grant back as long as you stay in the home for a minimum of 5 years. There's no payments. For any reason you do move out of the house and you sell it, you would have to pay back the grant to the state. For any reason you want to refinance it and consolidate it into the first mortgage, there is going to be a specific fee that you would have to pay for the state, but there's no payment, there's no interest on it. So if you keep things the way that they are for a minimum of 5 years, it's a forgivable grant.
Completely forgivable, and I think you might know better than me, the statistic of people that move into their house, how long they stay there is over 5 years anyway. Most people stay 7 to 10 years or something like that. So chances are you're going to be in that house. And then the other part, the last part that really gets me excited, because I talk about multifamily houses a lot, is that this program works for any property 1 to 4 units. So, you know, when you do the math and what you're paying, and you're not paying almost anything out of pocket, you know, we already talked about $1,000 or less to get into the house, and then you have a tenant or tenants helping you pay the mortgage. So
yeah, so for example, let's say you're paying an average of $1,500 per month for rent. And you buy a house for around $300,000 and you're renting one of the units. Let's say your total monthly payment for the mortgage, taxes, homeowner's insurance, and the mortgage insurance, let's just highball it as around $2,600. If you're capable of collecting $1,500 in rental income and your payment's going to be around $2,500, that's you paying $1,000 a month to $1,100 a month to be a homeowner. To own.
Yeah.
And you're paying yourself back. We were talking about this before we even started filming. One of the things we're saying is that no matter who you are, you're paying a mortgage. Unless you're living at home with your parents, either you're paying somebody else's mortgage or your own mortgage. And by owning a two-family home, the values of these properties go up a lot higher per year compared to the single-family home. So to build that equity long-term wise and to pay down the mortgage.
To have someone help you pay down the mortgage.
Exactly. Yeah. Now it's a long-term benefit and a strategy that a lot of first-time home buyers are capitalizing on, and we're putting this video together to really share it with the state and really a lot of families out there that are struggling to really raise or save that down payment.
It's tough. Yeah, it's tough to get to where people think they need 20% down.
Right.
You don't. Right. And now with this program, you can get the whole 3.5% down covered.
Exactly.
At the right purchase price.
Exactly.
You know?
Yeah. And on our end, we make it really simple, and there's no fee to get pre-approved. Or to see if you do qualify for the program. It's really not too time consuming. It takes 10 minutes for the app. Cool. If you have the documentations available, great. You could upload them to the portal. The portal also gives you the ability to be able to digitally verify your assets. But it's easy, and we just want to share it with everybody, get it out there, and help as many families purchase a home as we can. So any questions, any concerns, feel free. You can reach out to myself or my team. But if you're ready to really get this process started, you should find a link on the bottom of this page. Just click it and create an account, and we'll take it from there.